Okay, this is your next chapter, standard costing. So these all topics, they are under one section, which is budgeting, forecasting, standard costing, variance analysis. This is one thing. High-low method or learning curve we use in our forecasting thing. And of course, we use forecasting for preparing a budget. Without forecasting, you can't do budgeting. Then comes standard costing. This is also used in the budgeting process. So first thing is that what is a standard cost? Now you should remember that the word standard cost means the cost of producing one standard unit of output. Standard costing, this principle applies in your traditional business environment. And by the way, we said it last time also, that budgeting is also an approach in your traditional business environment. Budgeting is not it's not very welcoming in modern business, though we still use it, but actually you can find the traces of budgeting in traditional business environment. And standard costing, what is a standard cost? Standard cost, like I said, that it is the cost of producing one standard unit of output. And standard unit of output, standard products, they are traditional business environment. So what is a standard output? You know, if you talk about Coca-Cola, that's a standard product. I mean, when you open up the refrigerator, there are 5 cans, all 5 of them are same. You can take, you know, the one on the front, or you can take the one on the back. There is no difference. It's a standard product. Most probably the pair of shoes which you are wearing, that's a standard product, because it was not made based on your requirement. You purchased it from some shop, and probably in some, you know, in some shopping mall. And some company, they manufactured 1,000 pairs of shoes, and then they distributed it in the market. One pair you purchased and one pair I purchased. We both are wearing the same shoes, probably with a difference in size, but essentially it's a standard product. If you talk about a 41 number, you know, a number 41 pair of sneakers, the same model, it's all the same. Many times furniture items are also standard products, like chairs, which are not been manufactured on client's request. Some companies, some furniture maker manufacturer, they make chairs and tables and they start selling in the market. These are called standard products. And because these products are identical to each other, they are same, they are not similar, they are even same. Therefore, we assume that their cost of manufacturing should also be the same. I mean, the cost of making a can of cola, a can of Coca-Cola is the same, because all of them are, they have the same material, same quantity, everything is same. So that is called standard cost. So standard cost is the cost of producing a standard unit of output. So whatever is your standard unit of output, making the cost of that. And standard cost includes what? Standard cost, it includes standard material, which mean, you know, how many square meters of wood you need in one table. Standard material, standard labor. Standard labor means how many hours we need. So we say that 2 standard labor hours, which means that each table will be needing 2 hours. It will not happen that one table you need 2 hours, another you need 3 hours. No, because these tables are same. So all tables will need 2 hours each. 2 meters of wood each. So standard material plus standard labor plus standard overhead, it gives you standard cost of making one standard unit of output. Now, the question is, why do we need it? We need it generally for 3 reasons. Reason number 1, to define our budget. For example, we know that our standard cost of making one table is $30, okay? So our budget next period is 1,000 tables. So 1,000 tables we want to produce. The standard cost of producing one table is $30. You've got a budget of $30,000. 1,000 tables multiplied by $30. $30,000 is your budget. So standard costing helps you in budgeting, number 1. Number 2, standard costing, it helps you in valuation of inventories. You go to your warehouse and you see how many chairs or how many tables do I have in my warehouse. Oh, in warehouse, we've got 100 tables. And you know that your standard cost of table is $30. So 100 tables are in warehouse, 100 multiplied by 30, $3,000 is the value of your closing inventory. This is done. So two purposes. Number one, budgeting. Number two, inventory valuation. And number three is control. Number three is control. For example, end of the month, I asked you that how many tables did you make? And you say that I made 1,000 tables. Now, based on the standard cost, I know that 1,000 tables should be $30,000. And then I asked you, how much did you spend? And you say, I spent $33,000. Oh, you spent 3,000 more, because we set the standard as $30. So 1,000 table means $30,000. You are spending 33, you are spending more. That is called control purposes. Now, this is like the introduction of this chapter. So standard costing is what? What is a standard cost? I just explained you that a standard cost is the cost of making one standard unit of output. The purpose is to use for inventory control and valuation. And by the way, what is the difference between standard cost and budget? The difference between standard cost and budget is that standard cost is for one unit of output, budget is for the total production. Like my standard cost was $30, but my budget was $30,000. So budget is for the total output, standard cost is for one unit. And the standard cost card, which means where you write down all the cost, shows full details of the standard cost of each product. Full detail mean standard material, standard labor, standard overhead. Uses of standard costing: to value inventories, to act as a control device, and to be done for budgeting. And the difference between actual and standard are called variances. So when you said that I spent $33,000, based on our standard, it should have been $30,000. You spent $3,000 more, and that $3,000 more is our variance, and we need to analyze the variance. We call it variance analysis. We need to analyze variance. You spent 3,000 more. It does not stop here. We need to find out why 3,000 or where 3,000 was spent. Did we used more material usage variance? Or did we purchased material expensive, material price variance? Did we pay more money to our labor, which means labor rate variance? Or did our people work very slow, labor efficiency variance? And similarly, you have variable overhead variances and fixed overhead variances. So we need to find out that this 3,000 loss, which we had made, where it came from. And that topic is called variance analysis. How do we set standards? So standard setting thing, first of all, you should remember that standards are not made by one person, okay? Not one person is making standard. Entire organization is involved, because production manager will say that, I need 2 meters of wood, and the purchase department will tell what is the price of 2 meters. Production manager will say that 2 hours of labor, and the HR department will tell how much money they should pay. Then management accountant is there, purchase department is there, technical department, administration department, logistics, warehouse. So everybody contributes in setting a standard, because when we said $30 is the cost of making one table, it includes a lot of cost: transportation inward, raw material warehouse, electricity consumption, overhead consumption, materials, labors, wages, many things. So everybody is involved. Now there are 4 types of standards. Among the 4 types, I would like to start with this one. The first one is current standard. This is where I start with. Current standard means that what you have achieved last year. What is your recent? Because you should remember that you set standards every year. We set standards for every year. So your current standards are like you prepare or make your standard at the beginning of the year. Like every year you set your standards. And by the way, it's not only about, setting standard for making a table. It is setting standard for a delivery. I mean, what is our delivery cost? How much time it takes? How much fuel it takes? How much labor it takes? So you set your standards. So whatever you did last year, whatever you achieved in the previous year, that is called your current standard. For example, we are already making a table for $30. This is what we are doing. This is what we have done. So this is our current standard. But then comes expected standard, which is also called, expected standards are also called achievable standards. Achievable standard means that we sit down together and we say, see, we are making table in $30. Is it possible? Can we make it into can we make some reduction in price? And everybody would say, we can make it in 29 or we can make it in 28. If we make certain efficiencies, if we achieve certain efficiencies, it is possible to make the table in 28, for example. So now that becomes your achievable standard, that becomes your expected standard. So current is what we are doing, expected is what is possible. And then comes the ideal standards. Ideal standards is a very conflicting area. Ideal standard means that the best possible thing, without any wastage, without any, idle time, 100% efficiency. So if you work with 100% efficiency, no waste of labor, no waste of materials, 100% efficiency, how much you can make this table for? The answer is it could be made in $24, okay? If you work for 100% efficiency. But the thing is that, is it achievable? Is it practically possible? Can you achieve 100% efficiency? The answer is that in most cases, no, it is not possible. It is not possible. Now, this is the approach in traditional business environment. In traditional business environment, they say, now that's, I said, it's a big difference in the two approaches. Remember traditional and modern business? Traditional business management, they believe that ideal standards are impossible and therefore they are demotivating, and they do not talk about the ideal standards, because if you start telling your people to produce table in 24, you are telling them to have zero defect rates, zero inefficiency, 100% perfect conditions, which is not possible. So it would be demotivating. And therefore, in traditional business environment, we don't talk about ideal standards. On the other hand, if you talk about the modern business environment, they take it with a different perspective. In modern business management, they say that, ideal standards are hard to achieve, but at least we should continue our journey in that direction, because we were at 30, then we moved to 29, and then let's move to 28 and try to move toward it slowly and gradually. We know that it is not possible today, and probably it is not possible tomorrow as well. But if we keep on improving, we know that what is the end point which can be achieved. We may not achieve it, but at least we know that this is something which is the end point. So they consider that in modern business environment, that ideal standards are in fact a source of motivation. You see now, 100% 180 degrees opposite perspective. Traditional business says ideal standard is demotivating. Modern business says that ideal standards are encouraging. You encourage your people. And then comes basic standards. Basic standards are what? Basic standards are usually done in government organizations, in bureaucratic setups. Basic standards means you leave unaltered over a long period. Like usually we say that standards should be revised every year. Every beginning of the year, you need to set up new standards. But if you do not revise your standards and you leave them unchanged, unaltered for years, that is called a basic standard. In businesses, you start making new technology. When new technology comes in, new methods of productions come in, your standards should change. But just like in some bureaucratic organizations or some government organizations, they have set some standards 10 years ago, they still are following them. And that is why people are not happy with them. not the inside people, not the outside people, because they are not changing their standards. Employees are unhappy, customers are also unhappy. Everybody is unhappy because they believe that things are done in an old fashioned way. And then you have expected standard. So this was very short, how to say, introduction of standard costing. We stop it here and then we move to the next topic. Standard costing is like just an introduction.